How do you really optimize your trading? How do you make a certain strategy work for you? Well, the answer is simple. It's to build and customize your own trading strategy. Think of it like music. A lot of musicians, well, they might make their own music. So when you look at a lot of strategies at a basic level, yes, there are a lot of foundational strategies, iron condor, vertical, that kind of thing, but they all stem from somewhere. And if you don't know how to kind of build and evolve your own strategy to modifying it, to making it yourself, you're going to be stuck in the parameters and in the box, and you won't have any kind of evolution to your progress in trading. So in this video, I'm going to share with you some insight on how to modify your own trading strategy, or modify kind of a base strategy, and then all of a sudden improve it, evolve it into making it your own, giving you an edge in your risk tolerance, risk behavior, the way that you construct things, how to modify the risk that's on there, you modify your profitability, and how to fine tune kind of the management cycle behind those trades as well. So let's kick things off and let's get started. I'm Sasha, the options coach. So if you're brand new here, thanks for joining me. And we're going to go and dive deep into this. Now, when we create a strategy, I want you to start thinking a little bit more modular. Think more Lego style, like, building blocks. At a base core level, what we have in the sense of calls and puts, this is what we've got. We've got kind of this quadrant where we are buying or selling, okay? And then the other thing on it is we are buying or selling either a call or a put. Okay, so that's what we've got. That's all it is when it comes to options trading. So if you buy a call, you're looking for things to go up. If you sell a call, you're typically looking for it to go down. If you buy a put, you're looking for it to go down. And if you sell a put, you're looking for things to go up. Okay, now, what is it that happens when you're building a strategy? Well, what does a vertical stem from? Well, a vertical stems from buying and selling a combination of these. So let's say I'm selling a vertical put. Okay, so I got a vertical put. The way that works is I'm selling one, okay, maybe below a certain stock price. I'm selling one put, and then I'm buying another put below that. So let's say I'm selling an 80 and then I'm buying a 76. Now I've created a vertical construction, and bam, I've got myself a strategy. Now, this is all fine. You've got different strategies for different things, and you might say, there's a lot of strategies out there. Yes, that's true. There are a lot of strategies out there. But what I want to show you here is that you can go in and actually modularize these things even further than you can dream of, or what's possible. So if you have a creative mindset, if you are understanding options at a deeper level, what you'll realize later on is you can modify things and making it your own. And that's what we want to think about, is we want to think modular. We want to take, hey, this component and this component, combine them together, and we're going to offset them. And then we get a strategy like this, bam, bam, bam. And that usually can work out to your favor if you understand them in depth. Now, I will say, as a warning, this isn't for the beginners or the lighthearted people that say, hey, I'm just kind of fumbling my feet. But it's important to understand and recognize, because it could show you the potential and the possibilities of what it is that you can do. Because what you start with is a bucket of cash, you're building, you're modularizing, and you've got yourself a strategy, and it's and it constructs you to your personal needs. And then you can modify it, you can tweak it, and so on. Now, I've done this in the past in some of our classes and workshops. So when we go in and look at it, I've done things like the vertical bridge strategy, which is kind of like my own strategy to verticals, but it's more of trading diagonals, but using vertical spreads. I'll show you this principle here behind it. It may be a little too complex, but if you're interested in kind of the class, you can check it out and grab yourself the class. But let's take a peek at something as simple as Carvana here. So let's say I want to build a vertical spread strategy. Okay, so normally what a lot of people do is, if they go in and they buy a vertical spread, that vertical spread might be costly or expensive, but they might know verticals, but they don't know diagonals, or they don't know how to sell premium against them, but using verticals. So I've got people that I coach where they are comfortable with verticals, but they are not comfortable with diagonals or calendar spreads or other components. So what we can do is actually use verticals in a similar way. So here I've got a vertical spread. Okay, so I've built it out. I've got a 345, 350 vertical spread. So I'm risking about 248 to make 252. Okay, and let's say we jack up the contracts to about 20. So 20 contracts gives me a risk of about $5,000 to try to make about $5,000, roughly in that same ballpark. However, if this thing continues to fall, I'm losing about that $5,000. Now, what I can do is the vertical bridge strategy. What it does is we can go in and start selling shorter duration options against it. So let's say I've got this 12 DTE option over here, and I might go in to the 12-day and I might sell some verticals against it, some shorter duration verticals, because what's going to happen is the shorter duration vertical will offset some of the losses on the longer duration. So I might win some of the shorter duration options here. Let's go to, I'm going to just, because it's after hours, I'm going to bring in some of these strikes a little bit, see if I can get it. There we go. So now if I sell, let's say 7 contracts against the 20, I've got myself a little bit of premium coming in, and now my max loss is cut by about $1,000. So the most I can lose is now 3,900 instead of the initial 4,900. So it cuts that cost quite significantly. So you can see we can do that time and time again. We can sell some short duration premium, and we can also do the same thing with a little bit of other strikes. So let's say I go to also June 27th, and I might go to 370 and a 375. So I could be selling premium multiple times against it. So now I've got a few vertical spreads, maybe 4 contracts here, 5 contracts here, picking up a few premium in different spots, and I've got myself a vertical bridge strategy. Now this is what I call it. There might be a different name behind it, but the principle is the same, is that when you really look at it, you know, I've got one core position, which is kind of like holding long stock, and then I'm selling little bite-sized pieces of verticals against it. And now my risk gets cut down even further, like 3680. And if this position stands still, well, even if it does not move, at least I'm collecting premium and income from those other little items that I'm selling. So now this could generate just $1,000 just from that. Now, yes, the other one, the longer duration, is decaying a little bit, but those short duration verticals help offset that. So that's my point, is that we are able to go in and sell, create strategies and construct things in a modular way, modular fashion, because the root, the basics behind all of this stuff, is the calls and the puts and buying and selling. So for example, what is a calendar spread or a calendar structure? Well, a calendar structure is just simply selling one, let's say a short duration, against buying one that's a longer duration, but the strike is the same. So they have kind of their own structure and foundation here, or construction. So everything there is just modular, and you have to think about how do you use that to your advantage to making something your own. Yes, there's a lot of core strategies. We've got, verticals to iron condors, which are 2 verticals, right? We've got calendars, 2 double calendars, so which is 2 calendars. I've got diagonals, or a poor man's covered call, which is kind of, a hybrid strategy. All of it, though, is the basics are still there and the same. The principle is the same. Buy low, sell high. Even if you're buying a calendar, you're selling it at a higher price. Let's say you're buying it for $295, and then you might be selling it for $330 or something like that. The principle is still the same. And that's what I want you to think about it. Most traders, they think and they memorize like the strategy. But what you can do is make it more modular, create some adjustments and tweaks where an iron condor that doesn't work, maybe you sell 2 option contracts on the put side, but only 1 on the upside when you have an uptrending or grinding market, because not all iron condors are created the same or equal. Right. So we've actually done an iron condor class not long ago. That iron condor class, we talked about a couple of different iron condors, from equidistant iron condors, equal delta iron condors, high probability, low probability, unbalanced, gamma, or also known as kind of reverse iron condors as well. So yeah, there's a ton of different ways to trade things. And really, it just comes down to how do you modularize things based on your own personal needs. So hope that helps, gives you a little insight. If you're interested in the classes, check them out. We've got a lot of classes, courses, workshops that we do. Absolutely incredible. Join us, check the website, and I will see you maybe on the next live class. Take care. Bye-bye.